All right. Hi, everybody. My name is Richard.lesperance. I go by the name of my man Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have David Little with me. Welcome, David, to the podcast.
Yeah, thanks for having me, Richard. Appreciate the opportunity.
It's my pleasure. So, tell us a little bit about yourself and tell us a little bit about your company, how you got started with Crown Capital Resources.
Sure. Name is David Little. I live here in Texas, United States. My background is actually in engineering. I worked for an oil and gas engineering firm for 15 years, and I did a bunch of different ventures in real estate, and ultimately landed on hard money lending. Started that company about 7 years ago, very much as a side hustle, a nights and weekends endeavor. And that secondary business grew slowly over time until about early 2024 this year, when it started overtaking my W-2. So I decided to make the jump. I resigned from my engineering firm in March, and I've been doing this lending business full time since.
Was it hard to get started?
It was as it is with any sort of entrepreneurial thing that you're doing as a side hustle, it's difficult to find the time. Luckily for me, when I started, I didn't have any kids. I was only, I was married. That was it. So it's certainly a lot easier the early you are in life. Once you start getting a family and then all the family commitments, it becomes a lot more difficult. But early on, the time standpoint wasn't that difficult. Um, it was very doable. And the nice thing about lending, and the reason it was more or less compatible with the engineering job, is unlike other ventures in real estate where there's could be a lot of kind of emergencies where people need you right now. It doesn't matter the time of the day. A lot of the deliverables in lending, they can be pushed to after 5 p.m. So a lot of the things would stack up during the workday, and I would be able to handle them, after 5:30 p.m.
How's the operations in regards to the operation of the business? How is it?
It's lending, if you do it correctly, is a pretty low risk venture. From an operations standpoint, the nice thing is there's a lot of operational workflow that can be automated. It's not a business that's very intensive from a human capital perspective. So right now we're managing about $20 million in funds lent out, and we only have a full headcount of the company of about 4 people. I think we could comfortably scale to the 30 to 40 million range and maintain our headcount. So it is one of those industries that you could put in place a lot of operations, whereas, a lot of other things in real estate, it's a lot more intensive from a human capital perspective. If you were a real estate flipper, as an example, and you wanted to scale from flipping 4 houses at a time to 8 houses at a time, you're going to have to find more crews, more general contractors, more tradesmen, and things like that.
So, what's the return on investment in that type of business?
So it depends if it's your own capital or if you're raising other third party capital. So we'll look at the way we started is we self funded our business for several years at the front end, which means it's just our own funds. We didn't have any third party investors. When you look at it from that standpoint, it ends up being about a 20% annual ROI on your money. And so I'll break that down. So essentially, the way to think through that is the average loan terms that people are lending out is 12 to 14% interest rate. And then on top of that, you make 2 to 4 points origination. And so we'll strike the middle of both of those. We'll say 12% interest and 3 points origination. And so if you're lending out capital and you're actually, because everything that we do is, keep in mind, very short-term lending. So we're trying to do 4 to 6 month loan terms. And so you're earning 12% capital over the year's period. So there's 12% ROI. And then you're actually taking that capital and you're flipping it 2 times over. So that's 3 times 2. So that's about 6% additional return on investment. So those two together, about 18%, and other small fees and things that you collect get you to that 18 to 20% ROI range. Now that does get diluted, of course, once you bring in third-party capital investors, because you're likely going to have to pay them somewhere in the range of 9 to 10% on their money. But the great thing about that is you're still able to collect that origination fee on that third-party capital.
How scalable is it?
It's very scalable. So to put it in perspective, like I mentioned, for the first 5 years of the business, we were self-funded, so it was our own capital. And then we started bringing on family and friends, and then outside investors, and we scaled from being worth less than $1 million to about 20 million in a 24-month period. So a huge impact. And keep in mind, we only went from a headcount of 2 people to 3 people. So it's scalable in 2 regards. Number one is, like I mentioned, it's not a human intensive business from the cap. You don't need to scale up people dramatically to scale up your loan book. And then the second thing to keep in mind is that the hard money lending space in general is an incredibly broad and huge category. So right now, even at 20 million, we own less than 1%, less than 0.1% of the loans that are being originated just in Texas alone. So we're put it another way, if you were to think about it from a pie chart, like we are a wedge of a wedge of a wedge in the pie chart. So the huge market cap, there's a huge addressable market cap, and it's scalable because the systems you can put in place are scalable as well.
You talk about fundraising using third parties. How does that work?
So the majority of hard money lenders, if they're not using bank capital, they're using capital from third-party investors. So essentially what we've done is we've created a 506c income fund, and we have third-party capital investors who want to earn a passive yield on their capital. So they will invest in the fund, and then the fund has certain guidelines at which it can lend out money. And then we, as an operator of that fund, as a GP of that fund, are in charge of the originations, the operations, the servicing of all the loans that we do within there. And so we're making the top line fee, but our investors are making a consistent 9 to 10% yield on their money every single year. So it's a way for us, because if you're self-funding the business, the ceiling on your business is only as much capital as you have. So you're going to run out really quick. So when we switched to this model 2 years ago, we realized that if we really wanted to go from, like I mentioned, 1 million to 5 million to 10 million to 20 million, we needed to bring in third-party capital. In order to do that, you really need to pay them a very, competitive yield.
So when it comes to self-funding, what's
Yes.
what would you say is the minimum startup?
You could probably get it, depending on which geographic area you're in. Canada might be a little bit higher. Texas, you could probably be a little bit lower. The Northeast in the United States, a little bit higher. But I would think in terms of saying, how much capital would it take to purchase and flip a single property in your market? And that's probably your minimum. So in Texas, if you had $150,000 to $250,000, you could probably go be a private lender to, a real estate flipper, and then flip one property at a time, which is what we did initially, right? We self-funded the business. Me and my business partner, initially, we each put in, I believe, around $200,000 each. And for the first number of years, we would only have 1 or 2 loans going at a time. So it was good because you're able to grow slowly. You're able to learn the ropes, get your systems in place before you really start scaling. But it is one of the things in the real estate world that does require more capital out of pocket. Generally speaking, if you're a wholesaler, you really don't need much capital to get started. If you're a flipper, you can leverage your funds and get away with it with, $50,000, $60,000. If you're building a rental portfolio, you could probably acquire one for, again, $40,000 to $60,000. But it's the reason why people typically start in different aspects of real estate and they kind of end up on the lending side, is because there is a barrier to capital. You need some money to get it going.
So you talk about setting up a fund. What about the regulations and all that, the legal aspect of it?
Yeah, so that's a good question. The fund is actually a product that's registered under the SEC, and there's we actually had to hire a securities attorney to get that written up for us. And so there's a lot of with that, there's a lot of now disclosures and financial paperwork that we have to do. But the great thing about it from a third party investor, if I'm coming into a fund, there is a contract within the fund, the subscription agreement, that defines exactly what this company can and cannot invest in. So if somebody, as we realize, we really tapped out our primary network of friends and family, and these are people who known us for a decade or have worked with us for a decade plus, and from a reputational aspect, there were no issues. But what we realized was, as we moved past those spheres, people wanted a different structure where there would be more assurances. And so we moved into this fund structure to essentially aid in the fundraising side. But a secondary benefit as well is it actually helps streamline and condense a lot of the operational aspects of the business as well. Because previously, we funded everything out of what's known as a participation model, whereas we would get a potential investment up. We would underwrite it, get everything ready, and then we would reach out to our investor pool, and then we would kind of Frankenstein all the investors in. So at a $300,000 funding opportunity, we might have 4 different investors on that. And the fund helps streamline that because everything is now out of the fund and everything gets pushed into the fund. So as you could imagine, things that are both on the front end being originated, and then on the back end, things that are being paid off, not having to deal with 4 people on both ends of that, instead dealing with one fund made things a lot easier in our business.
Do you have a minimum amount that you try to keep in the fund?
Well, we don't necessarily have minimums for the fund. We're trying to grow it over time. Right now, our goal by the end of 2025, we want to 2x the size of the fund. So our goal is to go from 20 million to 40 million in the next 12 months.
And what about when you do the lending process? What happens when there's late payments or defaults?
Yeah, so the nice thing about hard money lending, and the reason people like it so much, is because you're lending on an asset first and foremost. That's why it's considered hard money lending. Is you have a first lien position on either a building, an apartment complex, a piece of land, or whatever that is. So if there are late payments, we typically work with our clients, borrowers, and try to understand, hey, what's going on. The majority of the time that we get late payments, it's just oh, I forgot to put money in the account. Let me switch some money over there, and it's a quick fix. In the 7 years we've been operating, we have had one formal foreclosure. And the nice thing about the jurisdiction in Texas in particular is it is very lender friendly. So we're lending on investment properties, and these are non-homestead, non-owner occupied properties. So when there is a formal default, the first step is that we send a demand letter from our attorney. If that doesn't get responded to, it gets posted up on the county board. And then within Texas, it's a really quick process. It can be as quick as 53 days from demand letter to the foreclosure sale. And then essentially at the foreclosure sale, if payments aren't made, we would take possession of the property. And then we would either sell it to another wholesaler, or B, we just put it back on the market. And then the biggest way in which you can de-risk that, and this is a metric that every hard money lender is always acutely aware of, is what is the loan out that we have on this property, and then what is the value. So we call that loan to value ratio. And the lower that value is, the more margin we have there between the capital that we have out and what the property's worth. So in our world, right now, our portfolio loan to value ratio is 62%. That's something we're very proud of.
If someone wants to get started in that industry, what are the things that should be thinking about and the steps in the process, the setup?
Yeah. So the easiest way to get started, especially if you don't necessarily have the capital base yet, is I would actually reach out to your local hard money lenders and see if you can come on as an origination agent. So the origination agents for hard money lending companies, they're the people who are on the very front end, and they're trying to connect with real estate flippers and people to help underwrite and originate these loans that eventually get underwritten, serviced, and done by the hard money lending company. But that front end experience is going to, A, there's a lower barrier to entry to getting going on that. And B, it's going to give you a really uh, meaningful insight as to how hard money lending businesses work. So you'll be able to see that process. That's what I would recommend. If I didn't do it the way we did, where this was kind of a side hustle and I was really looking to get in, I just probably would have gotten, I would have gotten hired by a hard money lending company so I could actually see the process. Because for us, it was kind of trial by fire. We didn't have the mentors and we were just learning as we went.
Uh, do you think, speaking of what you just said about mentors and all that, what about education? Like, where, if someone is starting out, where can they learn a few things? Well, not a few things, but where can they educate themselves before they get into that kind of business?
There's a few, there aren't, there's the, one of the best ones I think is the Hard Money Bankers podcast. Um, and then besides that, the best case scenario is probably in my somebody local. You can go to a real find another lender and just ask them to ask them out to lunch and just pick their brain on it. The overall structure of what we do is actually relatively simple. That's the nice thing. We do one thing, we do one general process, and then we just do it over and over and over again, 50 to 100, 150 times a year. And so I think that the overall learnings of how our process, our business works is relatively more simple. But yeah, my main thing would be that podcast or finding somebody in person to really pick their brain on it.
What are the pros and cons for the borrower when it comes to hard money lending?
Pros is they're able to make a what's still known as a cash offer and close very, very quickly. So oftentimes, and this is the reason that hard money lending companies and banks don't really play in the same world, is because a bank will underwrite and lend, and that process takes, 45 plus days. In our world, we could underwrite and close on a property in 2 to 3 days. So that creates a huge advantage for a flipper that can go out and make cash offers on distressed properties and tell them, hey, I want to buy this house. I'll close by the end of the week, and you can take a cash. It's an as is offer, and so they're able to number one acquire properties that they wouldn't otherwise have been able to do. The second thing is they can lever up their capital, and so the easiest example I generally give to people is I say, if you were a real estate flipper and this is how you're, putting bread on the table, this is how you're making your primary income. Even if you had, let's call it $300,000 cash, you would probably still choose to use a hard money lender, right? Because if you think about it and you'd say, well, if I have $300,000 cash, that means realistically I'm flipping one property at a time. And let's say each of those flips takes 6 months. Well, at the very end of the year, I flip two properties. So what you can instead do is take that $300,000, put 60,000 in each property, and flip 4 to 5 properties at the same time. At the end of the year, instead of flipping two properties, you flip 10 properties. And in addition to that, you're able to achieve economies of scale as well, right? So you can keep crews running, you can suppress your costs, you can buy materials more in bulk. And so the negative side of that is, our capital is expensive. 12% capital is expensive capital. 3 points origination is expensive, but the reality is they are those higher rates because we're built towards short-term loans. If at the end of the day you're looking at a flip, you're looking at call it a 4 to 6 month loan term, and you've got to pay 12% interest on that. The way to think about that is, well, if I'd self-funded this, I would have made $40,000 in net profit. Since I'm using hard money lending, maybe my net profit is closer to $30,000. But like I said, since the order of magnitude is so much different, at the very end of the year, you'd say, well, I didn't flip two, I flipped 10, right? And so, okay, I did lose 10,000 on each one, but I did five more, excuse me, eight more properties than I would have done had I self-funded. So that's why a lot of the flippers tend to use hard money lending, just because it allows them to really expand the total amount of projects they can do per year on a given amount of capital.
So that type of lending is for more for flippers.
Yes.
Okay.
Yeah, that's right.
And what about the credit if people have bad credit?
That's actually something that most lenders are a lot more lax on. Whereas banks primarily lend on credit and income. And the reason they do so is because if a bank is lending on a primary residence with a homestead on it, it's going to be very challenging for them to actually take possession of the property. So for banks, it's a lot more about, hey, what's the probability that you're going to pay this back? For us, it's different since it's very, very easy for us to actually take that collateral back if something happens. When we underwrite properties, the first criteria that we really look at is the project itself. Because if something goes wrong, that's what we're going to take over. And so if it's a really, really good project, and if the borrower is a little bit on the weaker side, let's say the borrower has a 650 credit score, we will likely do the deal, right? So, but on the opposite end, if a borrower has a 700 credit score, but it's a really weak project, and they have no renovation experience, we would be less likely to actually do the deal. So it's a very different model than people are used to. It's less about credit. So we do pull credit. We try to understand why they're, if somebody has a low credit, what happened there and whatnot. We want to obviously make sure it's no major red flags, but it's not one of our primary lending criterias.
Mhm. It's mostly based on assets, right? And the
That's right.
assets that they have.
Yeah. And the concept is, like I mentioned, our portfolio loan to value ratio is 62%. So, that means, roughly speaking, we've got first lien positions on, we have about $20 million of notes out, and we have first lien position on roughly $34 million in assets. So when that loan to value ratio is really favorable like that, that in a case of foreclosure, statistically speaking, you're going to be okay. You likely will not lose money.
So what advice would you have? What are some advice that you would have for people who want to get started in that type of business?
Yeah, I would say that as it is a lot within the real estate world, um, usually the first step is gaining knowledge and networking. So what I would recommend to people is to uh, get on different social media groups, try to figure out where the real estate meetups are happening. Typically, they're at bars at 4 to 5 p.m. and start going to those and just start talking to people. And what you might find out is that after talking to several different people, you might want to go down the hard money lending route, but real estate is so incredibly broad. I started with um, building a single family home rental portfolio, and then I moved in and did some raw land property development, and then I moved into Airbnb space, and then ultimately I ended up in the lending world. So be open to change, and just be open to going in and saying the real estate market is very broad. There's a lot for me to learn, and maybe I want to pursue hard money lending, or maybe I want to pursue wholesaling or whatever. I would just start working on networking and knowledge, attaining as much knowledge you can as early on.
Where can people learn more about you and follow you?
Sure. My personal email is david at crowncapitalresources.com. Our website again is crowncapitalresources.com, and our Instagram is the same as well. So Yeah, if anyone has any particular questions, please feel free to reach out and I can put you in here. So if we're in the same city by chance, we'll try and meet up. But if not, I'm happy to at least put you in contact with somebody who would might be in your local market as well.